Before it was a disaster, WeWork was a dream, a $47 billion dream. But when investors finally looked under the hood, they found more questions than answers. In 2019, WeWork was one of the most valuable startups in the world, worth nearly $47 billion. It wasn't just leasing office space, it was revolutionizing the way people work. Or so the pitch went. It all started with Adam Neumann, the charismatic, barefoot visionary who promised to elevate the world's consciousness through real estate. He wasn't just selling office space, he was selling culture. It was backed by SoftBank and fueled by venture capital FOMO. WeWork expanded into 29 countries and over 100 cities within a few short years. They signed long-term leases on premium properties, then rented them out short-term to startups and freelancers. It was real estate arbitrage wrapped in a tech company valuation, because slapping.com on something or talking about community magically made profits irrelevant for a while. But something didn't add up. The company was bleeding cash, over $2 billion in losses annually, yet it kept growing. Investors bought into the story until they saw the numbers. Hey, I'm Michael from Prezzo. I help multinational businesses navigate the complexities of transfer pricing, tax structuring, and global expansion. Now, if you're a CFO, a tax advisor, or a scaling entrepreneur, you've probably asked yourself at the same point, how do we structure this properly before it becomes a mess? Today, we are looking at what happens when you don't. Because WeWork isn't just a high-profile failure, it's a real-world case study of how poor entity design, tax logic, and governance can undermine even the most hyped business on earth. In this episode, we will break down what went wrong with WeWork's global structure, why investors pulled out, and what that has to do with transfer pricing, and what you can do to avoid the same fate, with practical and strategic takeaways. And no, you don't need to be a $10 billion unicorn that make these mistakes. Plenty of smaller businesses do too. They just don't make the headlines. They're like cautionary tales are usually whispered in hushed tones at local chamber of commerce meetings right after the bit about the terrible coffee. So let's dive in, starting with how WeWork became the biggest name in flexible workspaces and why it didn't save them. In 2019, WeWork filed for an IPO. That's when the truth started to leak. Analysts raised eyebrows. The media started digging. Valuations began to tumble, and Adam Neumann's personal decisions, like leasing buildings to WeWork and charging millions for the We trademark, raised even more red flags. But the real issue, it wasn't just mismanagement or maybe founder drama. It was how the company was structured. Behind all the headlines and hype was a complex maze of entities, IP licenses, and intercompany deals. They didn't make sense, not to regulators, but not to investors, not even to WeWork itself. So let's unpack it. A business can survive losses. It can even survive bad leadership, but no business, no matter how hyped, can survive a broken structure. That company was built on a tangible web of entities, leases, and intercompany transactions that defied logic and exposed deep, structural weaknesses. From a distance, WeWork looked like a rocket ship, but structurally it was closer to a Jenga tower. Pull the wrong piece and the whole thing falls apart, and the spoiler alert, someone always pulled the wrong piece, usually the one labeled basic financial controls. We are not just talking about bad management or lavish spending here. We are talking about core design flaws, how the company was set up legally, how it moved money between countries, and how it managed or failed to manage intellectual property, leasing arrangements, and investor capital. In this section, we'll walk through the 4 biggest structural flaws that contributed to WeWork's implosion and explain why getting your structure right is just as important as having a good product or a visionary founder. Let's start with the foundation, the company's legal architecture, because if the walls of your house aren't connected properly, it doesn't matter how nice the furniture is. You can't scale the chaos. And yet, that's exactly what WeWork tried to do. Across 29 countries, with over 800 legal entities and no clear blueprint. Most successful multinational companies expand globally using intentional structuring. They define a holding company, centralize control, assign value to the right entities, and build transfer pricing logic that scales. WeWork did the opposite. At its peak, WeWork had over 800 legal entities across dozens of jurisdictions, often structured ad hoc based on next lease deal or market expansion. There was no coherent legal architecture, no tax strategy, no standardized intercompany model at all. And the result, an organizational maze. Local entities signed long-term leases, other entities held branding rights, still others operated co-working spaces and received revenue, but no entity owned the full value chain. And when investors asked simple questions, where's the core intellectual property? Who's the actual employer of record? Which entity owns the customer relationship? The answers were either unclear or alarming. Worse, many of these entities were created without long-term legal or tax logic. Some had overlapping functions, others existed only to hold leases. Some even had conflicting governance. So while WeWork presenting itself as a tech-enabled global platform, under the surface it was held together with duct tape. And maybe some of that vision board energy Adam was talking about, duct tape is surprisingly versatile, but not that versatile. And remember, when your company spans continent, complexity is unavoidable. But unmanaged complexity, that's a liability. One that grows with every new market you enter. But it wasn't just the entity map that raised eyebrows. Investors couldn't tolerate complexity if they trusted who was in the control. Unfortunately, the man at the center of it all was also the landlord. Imagine pitching investors on a $47 billion company and then telling them you personally own the brand name and charge your company to use it. Corporate governance isn't just a checkbox. It's a signal, especially to investors, that your business is designed to last. And one of the biggest red flags in WeWork's IPO wasn't the numbers, it was in the control structure and who held the keys. Adam Neumann, the co-founder and CEO, didn't just lead WeWork. He personally owned assets that were critical to the company's identity and operations. Allow me to break it down for you. In 2019, Adam personally trademarked the word "we" and then charged WeWork $5.9 million to use it. He brought properties and then leased them to WeWork, profiting from real estate deals his own company signed. Through special voting shares, he held outsized control over the company, even compared to other tech founders. And in many overseas markets, local subsidiaries were ultimately structured under entities he controlled, rather than WeWork Inc. Now imagine you are an institutional investor. You're asked to pour millions into a company, but the CEO is licensing back core assets to himself. Even if the financials looks okay, and they didn't, this governance model screamed like conflict of interest, more like it was standing on a desk with a megaphone wearing a t-shirt that said, "I am a giant conflict of interest." It also created enormous transfer pricing headaches. Why? Because WeWork was paying related parties, often tied to Neumann, without clear documentation, market benchmarks, or arm's length terms. That's a compliance nightmare in any jurisdiction. And when regulators or auditors start digging into why money is moving between related parties and how it's priced, things get expensive very quickly. But beyond tax risk, the real damage was credibility. Wall Street wasn't just worried about valuation, it was worried about who really controlled the company and whether that person's interests aligned with the shareholders' interest. And some spoiler, they didn't. And if you think the founder arrangements were messy, wait until you see how money flowed across borders. Because when there is no pricing policy, there is no predictability and no trust. Transfer pricing isn't just a tax tool. It's how a multinational tells the world where it creates value. And WeWork, it couldn't answer that question. As WeWork expanded globally, it entered into hundreds of cross-border relationships between parent companies, subsidiaries, franchisees, and joint ventures. But while the business scaled fast, its transfer pricing framework never caught up. But let's be clear, even like every multinational enterprise, whether it's Amazon, Airbnb, or your own consulting firm going global, needs a clear TP policy. The one that answers who creates value, who bears the risk, how are profits allocated. And in WeWork, unfortunately, it seems that it had none of that. Let's take an example. A WeWork entity in London signs a lease for 10 years. That's a massive fixed cost. But the entity doesn't directly earn the membership revenue. That comes via platform fee collected by another entity in New York. Meanwhile, a third entity in Ireland invoices for a global brand support, and no one can explain how the payments are priced. This created three major problems. Tax, exposure to tax, without documented policies or comparables. Regulators didn't verify whether intercompany charges were at arm's length. That opened the door to audits, penalties, and potential double taxation. Second is profit fragmentation. With money flowing arbitrarily between entities, WeWork couldn't demonstrate where profits were earned or defend losses in high-cost jurisdictions. The result, disconnected financials, opaque reporting, and other. And the third, investor confusion. Remember, transfer pricing isn't just for tax authorities. Investors care deeply where the value is created and how it scales. If you can't show where margin lives, you can't defend your valuation. Even simple arrangements like management fees and brand royalties weren't priced with standard benchmarks. No CUPs, no TNMM, no master file, no defense. It was effectively transfer pricing by, vibes. Does this intercompany charge feel right, man? Are the profit chakras aligned? Not a strategy that generally impresses tax auditors. Funnily though. And as we've seen time and time again, when the structure lacks economic substance, it doesn't just invite tax scrutiny, it undermines the entire business model. And when investors start seeing that kind of chaos in your company flows, they stop asking about growth, they start worrying about exposure. Let's talk about why structuring isn't just about taxes, it's about trust. Investors can price risk, but what they hate is uncertainty. And WeWork's structure was a masterclass in uncertainty. When WeWork filed for its IPO in 2019, the headline number, a $47 billion valuation, wasn't the first thing that scared investors. It was what they couldn't see. The structure was so fragmented, so opaque, that analysts couldn't determine basic facts. Where were the profits generated, which entities held the liabilities, who controlled the intellectual property. These aren't technicalities. They're fundamentals, because structure tells a story. A clean structure says, we know where the value is created. A messy one says, we hope you don't ask. And in this case, you need to be sure. Investors always ask. Let's look at how structure affects perceived risk. A company with a centralized IP entity in a favorable jurisdiction with clear transfer pricing logic and consolidated reporting that's somehow, scalable, auditable, and most importantly, investable. Now, let's compare that to what WeWork did. Hundreds of loosely connected subsidiaries, related party transactions with little documentation, IP and real estate entangled with the founder's personal assets, no consistent financial reporting across geographies. This lack of clarity didn't just raise tax concerns, it spooked capital markets. SoftBank valuation of WeWork plumped from $47 billion, mentioned before, to less than $8 billion in weeks. The IPO was pulled, Neumann was ousted, and investors walked away. Not because the business lacked potential, but because the structure destroyed confidence. In private equity, there is a saying, you can fix operation. You can even fix tax strategy. But if the structure is broken, just walk away. That's exactly what happened here. So what can we learn from this? It's not just like a cautionary tale, it's a case study. Because when structure fails, transfer pricing becomes the pressure point. And that's where we are headed next. Transfer pricing isn't what killed WeWork, but it's where the cracks became impossible to hide. By now, you've seen how WeWork's internal chaos, entity sprawl, founder control, undocumented transactions created a perfect storm. But if there's one area where it all came together, one area where things could have been fixed early, it's transfer pricing. Because transfer pricing isn't just about tax, it's the language your structure speaks to the outside world, to regulators, to investors, and to your own executive team. Let's unpack the key lessons. TP is architecture, not accounting. Too many businesses think of TP as a back office compliance function. But in reality, your TP model defines where your IP sits, which entities bear risk, how your global margins are allocated. WeWork lacked this logic. Their entities moved money, signed leases, and booked costs, but without economic rationale. That left tax authorities and investors guessing. A robust TP structure starts with a functional analysis. Where is value created? Who performs the DEMP functions, development, enhancement, maintenance, protection, exploitation, and of intangibles? Who actually takes on risk? If WeWork had run this analysis in year 2, not year 7, it might have avoided the collapse of investor trust. Second lesson we can learn from it is centralized IP and decentralized execution. One best practice among global tech companies is to centralize core IP and brand ownership, typically in a holding company or IP entity, often in a favorable jurisdiction with substance. Then, execution is decentralized. Local operations, entities provide services, pay arm's length royalties or management fees, and retain limited risk. What did WeWork do? Brand IP was nowhere. Or worse, it was owned by Adam Neumann personally. Local entities bore heavy leasing risks without compensation or risk reallocation. Transfer pricing documentation was non-existent or ad hoc. Contrast with companies like Airbnb, which early on centralized IP in Ireland and licensed it methodically, that gave investors the confidence and gave auditors less to question. third lesson we can learn from it is pricing that should reflect the risk, not just the cost. A key principle of the TP is that entities taking more risk should earn more in return. In WeWork's case, local subsidiaries often signed multi-year leases, taking huge fixed cost risk, but had no mechanism to be compensated if revenue underperformed. Meanwhile, other entities collected brand fees or platform revenues but didn't share downside. A compliant TP model would have been built in risk-adjusted services fees, profit split or residual methods were appropriate, clear documentation justifying who gets what and why, and most importantly, substance behind every payment. Fourth lesson we can learn from it is transfer pricing isn't just a tax tool, it's a credibility tool, right? Let's say you are a VC or sovereign wealth fund looking at a Series D company. You want to know where is value generated, who owns the key intangibles, can this structure scale to 20 plus countries without imploding? If the CFO can't explain the TP logic in one slide, or worse, says we are figuring that out later, you are technically walking away. WeWork lost investor trust because its structure raised questions instead of answering them. Transfer pricing wasn't the problem, but it exposed all the problems. When you design your TP right, you're not just satisfying regulators, you are showing the world you are built to last. So if you are running a high growth business, what should you do differently? In the next section, we will break down the 4 structuring principles every multinational should follow to avoid becoming the next cautionary tale. You don't need to be worth $47 billion to make $47 billion mistakes. Though, if you are going to make them, it's certainly more spectacular at that scale. Go big or go home, right? WeWork definitely went big on the mistake front. So here's how to get your structure right before the cracks appear. WeWork's story may feel extreme, and in many ways it is, but the underlying structural problems, they are surprisingly common. We've seen fast-growing companies in SaaS, logistics, fintech, you name it, fall into the same traps. Prioritizing speed over structure, delaying transfer pricing until regulators showed up, creating entities on a whim without a map. The good news, these mistakes are pretty easily avoidable. Let's walk through the 4 structuring principles every multinational or soon-to-be multinational should follow. First of all, build structure to match your value chain. Too many companies treat corporate structure as an afterthought, something legal and tax will clean up later. But if your legal setup doesn't reflect your economic reality, where IP is developed, where customers are acquired, where risk is taken, you are actually inviting problems. Your structure should be coherent, not scattered, aligned with business functions, scalable across borders. You can start with a clear global blueprint, not just for today, but for where you will be in 3 to 5 years. Second, prioritize transparency and governance. Investors don't expect perfection, but they do expect clarity. Make sure your group structure has a clear headquarters or holding company, separates operating, IP and financing entities, has clean governance around related party transactions, and yes, document your transfer pricing policies early, even if you are pre-profit, even if you are pre-Series A. Why? Because transparency today builds investor trust tomorrow. Third, don't optimize for tax. Optimize for control. A common mistake, like trying to chase tax savings before building operational logic. WeWork learned this the hard way. Chasing tax arbitrage with scattered entities only works if you can defend the entire structure. Instead of asking how do we pay less tax, ask yourself who owns the key assets, who bears operational and financial risk, how can we document and defend that globally. Tax efficiency comes from good structure, not the other way around. Fourth lesson, invest in strategic TP early. Transfer pricing isn't a patch, it's a blueprint. As soon as you expand into a second country, you already should have some sort of a master file that explain your business model. Local files that support the intercompany charges you have there. Clear contracts, benchmarks, and pricing logic. You don't need a big four budget, just clarity, consistency, and some support from experienced advisors. Strategic TP won't just protect you from audits. It will increase investor confidence, support valuations, and make your business easier to scale and eventually easier to exit. So what's the bottom line? WeWork's fall wasn't about vision, it was about structure. And in today's global economy, that's the difference between unicorn and implosion. So let's wrap it up. WeWork didn't fail because it had a bad idea. It failed because it couldn't structure a good idea globally. Let's be honest. Co-working as a concept didn't fail at all. Global expansion didn't fail. Even Adam Neumann's vision, for a better or worse, wasn't the problem. The real failure was pretty much structural. From a messy web of entities to related party chaos to non-existent transfer pricing and founder conflicts of interests. WeWork collapsed because the foundation couldn't support the scale they were going for. And here's the thing, if you're a founder, CFO, or global tax advisor, that lesson matters because your legal, tax, and transfer pricing setup isn't just a cost center, it's a strategic asset. Done right, it supports growth, attracts capital, and builds resilience. Done wrong, it kills companies with billion-dollar valuations. So the next time you think structuring is something you'll fix later, remember WeWork. If this breakdown helped clarify the risks and lessons behind the WeWork story, please hit subscribe, leave a comment below. Have you seen structural chaos up close? Or do you want us to break down another real-world tax or transfer pricing story? So I think that's all for today. See you in the next one.